The escalating Middle East conflict has triggered a sharp spike in global oil prices, reigniting inflation risks. What was once seen as an extreme scenario, no rate cuts from the Fed this year, is steadily becoming the dominant bet among bond options traders. Market expectations for Fed policy have undergone a fundamental shift, moving from optimism about easing to cautious waiting. Rate cut expectations have cooled significantly, while the probability of a hike has climbed notably. The worsening situation in the Middle East is the core catalyst for this shift in expectations. As the U.S.-Israel conflict with Iran escalates, global energy supply security faces serious challenges. International crude prices have surged nearly 20% this week alone, with Brent briefly topping $84 a barrel and WTI approaching $78. This spike in oil doesn't just directly lift energy prices. It risks further fueling inflation expectations, adding new pressure to the Fed's inflation fight. The latest data compiled by the Atlanta Fed clearly reflects this shift. As of Wednesday, traders pricing SOFR futures options, which are tied to the Fed's policy rate, now see a 25% probability that the Fed will keep rates in the current range through December, delivering no cuts at all this year. That's up sharply from 17% last Friday, the last trading day before the Iran conflict erupted. The nearly 50% jump in just a few days underscores how quickly confidence in Fed easing is crumbling. Looking at the probability distribution across scenarios, no cuts is now the single most likely outcome. According to the Atlanta Fed, beyond the 25% chance of no cuts, traders see a 24% probability of just one 25 basis point cut this year, and only a 12% chance of two cuts, both lower than the no-cut odds. Even more striking, expectations for a Fed hike are heating up. The probability of a hike now stands at 16%, double the 8% seen last Friday. That means some traders are already beginning to price in the risk that the Fed could resume hiking if inflation spirals out of control. When oil prices spike, we have to prioritize the pass-through to inflation, stresses Dan Carter, senior portfolio manager at Ford Washington Investment Advisors. This directly lifts inflation expectations, which in turn dramatically reduces the likelihood of Fed cuts. While the aggregate probability distribution still slightly favors some easing, this dramatic repricing clearly reveals the violent swings in market confidence. The relentless surge in oil has traders seriously questioning the Fed's ability and willingness to lower borrowing costs. Options flow over the past few days confirms this trend. Demand for hedges against less Fed easing has persisted, with traders using options to shield against policy falling short of expectations. Rate swaps, another key tool for betting on Fed policy, also reflect expectations of a less dovish stance. Traders now expect about 35 basis points of cuts by year-end, down sharply from 60 basis points just last weekend, a nearly 42% reduction in expected easing in just a few days. This sharp cooling in rate cut expectations has directly triggered a sell-off in treasuries, pushing yields to multi-week highs and completely reversing February's strong rally. Back in February, fears over AI's potential disruptive impact, combined with cracks emerging in private credit markets, had fueled a surge in safe haven demand, driving bond prices up and yields down. Now, with oil surging and inflation risks back in focus, the market logic has flipped. Safe haven demand has given way to inflation concerns, and selling treasuries is the dominant trade. Overall, the oil surge triggered by the Middle East conflict is battering the Fed's inflation floor, leaving policymakers in a bind. If inflation continues to rebound on higher oil, the chances of any cut this year will shrink further, and rates may stay higher even longer. If the Fed forces a cut anyway, it risks unanchoring inflation expectations entirely. Right now, no cuts has gone from an extreme hypothesis to the market's base case. Going forward, oil prices and inflation data will be the core variables determining the Fed's path.